If you're going to rely on other people, don't get comfortable with it. Don't get complacent. In the Marine Corps, we say, I'm a veteran. In the Marine Corps, we say complacency kills, because it literally, the Marine Corps will kill you if you're complacent, meaning you just get too comfortable with your situation and you just start letting things slide, the little things slide. It's a slippery slope.
Hello, everyone. Rick Alpert here with another episode of The Key to the City of Angels. Today, I'm excited to have Chris Jansen of the Cash Flow Authority here. Chris, thank you for coming on.
Hey, thanks, Rick. Really happy and excited to be here today.
Yeah, so for those that have been following my social media channels, I was actually on Chris's podcast recently. It was a lot of fun. So now we get to kind of flip the script a little bit. But we're going to talk a lot about real estate investing, kind of like in general and in the mindset. So, Chris, why don't we first get started? How did you get into real estate investing, and then kind of what you're doing as kind of like an investing coach?
Yeah, so it's been a journey for sure. It's been a journey, but it's kind of all started for me not that long ago, the COVID era, which it's been, 6 years actually now. So that it has been a while. It is wild, right? Everybody's still kind of, the talks have calmed down a little bit. We're not in COVID era anymore, right? But
Sure.
nonetheless, March 2020, started working from home. We got that order, in California, and I was in a 1 bedroom apartment by myself, no girlfriend, no wife, no kids, no dog, just me. And I was just bored out of my mind. Like, I was just looking for stuff to do. And so I started reading on investing, and that would be the last place I would ever go. I'm like, why am I? But my coworker, gave me some hot tips in the stock market, and like, oh man, did you see that, United or some airline dropped, $100 a share? And I'm like, oh, what does that even mean? So I knew nothing about it. I'm like, all right, well, let me just start to read, because hey, if there's a bunch of opportunities, in the stock market, then hey, let's jump in, because what else am I going to do with my life right now? So anyways, I started there with the stock market, read a few books, dabbled in that, but quickly realized how emotional that can get when you're staring at a chart all day, just ups and downs. And so anyways, it just didn't work out for me, and found my way into real estate as a different, alternative sort of asset to invest in. My dad he owned some real estate, not a lot, but he had a duplex in Wisconsin. So he had that experience, and he's a tax preparer. So kind of told me about the tax benefits. I read a Bigger Pockets book, and got really intrigued by that. And then I tried doing it on my own, and I really wanted to, I had all this equity in my condo because of the big boom right after COVID. I wanted to sell that and go house hack, use the equity to go house hack. But I put in probably 12 to 15 offers in that range, and kept going higher on my offers and just never got anything accepted. And kind of glad it didn't, to be honest, because that condo I still have, it's a rental now, cash flows, and the interest rate's extremely low. But eventually, after about 3 years of trying to do this all, on my own, just with me and a realtor helping me find properties, he wasn't really an investment focused realtor. Then I found a group who 90 classes in real estate, investing education, mentorship, masterminds, all this stuff. And within 3 months, I got my first deal. They just showed me what I didn't know. I didn't know what I didn't know. They showed me how to use the equity without selling my condo, and the rest is history. But anyways, that's how I got into it. So
Yeah, and actually, my first was a condo as well. I bought a condo, fixed it up, rented out the other bedroom, then did the line of credit to buy the second house hack. Eventually, I sold the condo to invest, all that. So,
yeah.
What does your portfolio kind of look like right now?
Yeah, right now it's a pretty good blend of, I do have a couple condos. I have one single family. I have 2 duplexes. I have a 5-unit, and I'm actually under contract right now to buy a 4-unit as well.
Yeah, congrats.
So thank you. Yeah, there's one in California, one in Utah. Everything else is in Wisconsin. And yeah, so I've started with the condo, the Utah single family, the Wisconsin single family, went into then duplexes, and then went into, the 5-unit, the 4-unit. So I'm kind of very slowly just adding doors and getting a little bit bigger on the product size, the actual properties. So, but I'm really excited about this 4 units too. It's going to be, I mean, the plan is the plan. It's got to work out as planned. It never does, but the plan's great. I love the plan. So we'll see how it goes.
Yeah. Have you noticed a difference? Because like all my rentals now are 2 to 4 unit properties. And that's really my sweet spot. I prefer is
Yes.
3 and 4 units, but there was a duplex. I'm like, I'll give it a shot. Have you noticed in terms of performance any difference between some of the multifamily versus the condo versus the single family home? I mean, I know they're different markets, but
Yeah.
just generally
Mhm.
speaking,
Yeah, it is tough because I only have a small sample size and they are different markets.
right.
So like on the one hand, California, that condo has been, it's a very low cash flow. It does
Mhm.
cash flow, but it's very low cash flow, but it's very low headache. The HOA, takes care of the big
Yeah.
stuff, anything structural. I had a roof leak at one point. They took care of it. And so it's there's like no overhead. I mean, the maintenance is like 1% of the rent. So I mean, it's crazy.
Right.
So, but then you're fighting. The HOA fee goes up every year, pretty much, and so your rent goes up, and they kind of just balance out. So I'm just riding it out, and I like it. Now the Utah condo, that one, it's a little bit negative cash flow. It's not so much a maintenance issue. I just kind of bought it wrong. I bought it with a different strategy in mind. But the
Mhm.
market itself, if you can get it for a price that it cash flows, I like that it's lower maintenance. I just don't like dealing with HOAs, to be honest. It's just,
That's a general consensus.
yeah, yeah. And, the Utah condo, the issue with that one, right? The California one skyrocketed in value, like I said, after COVID. The Utah one, I bought it after COVID, you know, early 2024, and it's actually depreciated. It's gone down in value since then. So not a lot, it's fine, but it's just, that's been the issue with that one. And then I also am selling the condo that I was living in. It was just my primary residence, not as an investment. And that one I bought July of 2024, so almost 2 years, barely any appreciation, very little bit, like 10 grand, but I put more than 10 grand into it. So it didn't appreciate, and,
Yeah.
when I say HOAs, I mean, again, I'm exiting the deal, and it wasn't an investment, but this HOA, man, there's all these requirements they have to meet. If the buyer does, first they tried to do FHA loan, and after about a month realized HOA is not going to,
It's not
they're
going to get
not
approved.
complying with it. It's not going to get approved. Then they switch. The buyers are committed, then they switch to conventional with 5% down. And now we've been sitting here. It's been 70 plus days, man, that we've been under
Wow.
contract. And I'm like, I'm just over it. But I'm paying for this place. I'm paying four
Right.
grand a month for this dinky little stupid condo. And it's just HOA, like the issue, what I'm told is they need to have like 10% reserves, and they're supposedly just below. They're at like 9.9% reserves or something crazy. So they
Wild.
need to show the paperwork to show they're 10 or above before it gets approved. So we're kind of just like sitting with our hands, just sitting around waiting. And so, anyways, without an HOA, this wouldn't be a problem. So that's
Sure.
just cautionary tales from a condo owner trying to sell his condo right now. But the single family, again, different markets. That one I bought more as a flip slash like a BRRRR method type thing,
Okay.
and that did work out pretty well. But again, cash flow is tight. It's very small, even though, I mean, I bought that property for $30,000, and it's,
Wow.
and then I put, I don't know, about 35,000 into it, and the rent's basically 1,100 because they have a pet, so they charge them more. So 1,100, so it's good. It sounds good,
Yes.
but even with all those numbers, like it's just such a small cash flow a month. It's like $200 a month cash flow after all
Yeah.
is said and done. So all that work, everything kind of falling into place where we wanted it, and it's just barely scraping by with cash flow. So I like the duplexes because, man, even if you get half the cash flow that you planned for, it's still going to perform as good as the single family, if not better. And then rents will go up over time. And then, hey, if you have one vacant unit, you still have another that's occupied to cover the mortgage. And obviously, as you have more units, that logic multiplies. And so, and then I mentioned the 5 and the 4 units. And these two, again, it's Wisconsin, but it's a different part of Wisconsin. And the 5, it's like the challenge with that one has been more on evictions and just getting the right tenants in there. And they're very small units. So the rents
Mm,
are, lower. But even with all that crap that I have to deal with, man, like if I just have 2 units filled, I'm paying the mortgage. It
right.
covers the mortgage. So if I get 3, I'm cash flowing. If I get 4 or 5, I'm like,
You're
I'm just,
sad.
laying back like a happy dog. Yeah.
Yeah.
And then the 4 unit it's why I'm so excited about it is because it's the bigger floor plan than the 5 unit, but there's 4 units, so it's
Hmm.
4 good sides. It's 3 2 bedrooms and 1 3 bedroom. It's in a better part of, still a rough zip code, but it's a better part of that area. So the rents are higher because of that and because it's just bigger units. And we're getting it with 3. This is something like that I like. I like to buy properties that where the units are vacant, because then I can just go in there and I can fix it up, make it pretty, and put my own tenants in there, screen them.
Sure.
And so that would have saved me a lot of time and hassle with the 5 unit, but you get what you get. And so with the 4 unit, 3 of the 4 are vacant. And so we're just going to get in there right away and start doing the work to make it nice and get the rents that we want. So yeah, so that one's going to be really good.
Yeah, it's funny because a lot of what you're saying is the same thing that I'm experiencing and other people are experiencing, right? So, a couple of things I always like. First of all, real estate's a very slow burn, right? Like I have
Yes.
a client
Yep.
where he lives off his rentals. I met him when he was already had his apartment buildings and all that. I said, "Did you always like make enough to live off of?" He's like, "No, dude. I was making like $100 a month in the beginning, $200 in the beginning. Like
Yeah.
there wasn't anything really.
Yeah.
It takes time. It's a very slow burn, which, not everyone realizes. They're hoping they can live
Yeah.
off it immediately. But for all the same reasons you mentioned, is why I like going the multifamily route, the
Yeah.
2 to 4 units
Yeah.
or larger. The goal for me is eventually go larger. The plan is I have some properties that actually are doing fairly well when they're rented. But the plan is to actually sell them because I can take the equity and literally get double the amount of units off the same one. But, going back to the condos, a lot of that's been the big talk of the town right now. It's just the HOAs are in rough shape. They
Yeah.
just are. They didn't
Yeah.
account for the reserves. The board members aren't real estate experts. They don't
Mm-hmm.
know,
Mm-hmm.
right? Like they're just other owners. And it's no fault. I mean, I've had clients ask me, like, oh, should I join the board? I said, why? Why do you want to go through that pain? Unless you're literally going to lock down. I have one client actually, she's the HOA president and she's on it.
Uh-huh.
She's like the stereotypical like Karen of the area, but she's like, look, I cited people for putting up birdhouses. And we're like, why? She's like, because it's attracting the squirrels, which is causing damage, and the HOA has to pay for that damage. Like, it's just like
Mm.
little things that people don't think about.
Yeah. Yeah.
But yeah, as an investor, most of my condo owners are selling.
Yeah.
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 And they're blaming the
Honestly,
HOA.
I would sell the Utah one, but I'm coming out of pocket on my residential one. I'd have to come out of pocket on the Utah one. I'm like, okay. I'm like, I can handle, like, the other rentals more than absorb the little bit of negative cash flow on it. So I'm like, let me just sit on this thing, man, because it's in Orem, Utah. It's an area that I think is going to, I know it will appreciate.
Sure.
It's gotta be the right market, and that could be 1 year, it could be 5 years, it could be 10 years. I don't know, but it just, if I give it time, that's time's your best friend with real estate.
Oh, for
Um,
sure.
and so the rents will eventually go up. But the biggest thing for me on that one is appreciation. Even if the rents go up, it doesn't, to me, it's just, I need the value to go up and make a little profit and then just get rid of it and move on, kind of thing. But I'll wait and just sit and wait on that one. At least for right now, that's what I'm saying. So ask me in a
Yeah.
year.
Right. We'll have you back on. Like, so let's reevaluate. Like, dude, this shit hit the fan. No. But okay, so here you are scaling. What are some of like the standard operating procedures they're putting in? Because that's one of the things that we're also working on our back end is like we
Yeah.
need to get a better because like stuff is slipping through the cracks. I'm noticing with some of these most recent purchases, and I'm
Yeah.
like, I feel like some of the stuff could have been avoided. What are some of the things that you're seeing
Yes.
and what you're doing?
Honestly, to me, the biggest, I mean, we all kind of have our own business models.
Of
Some people are
course.
more hands on than others. I do use property managers, and except
Hmm.
for my one condo in California, everything else I use a property manager for. And again, the bulk of my stuff's in Wisconsin, so I have just two managers in that area. So
We're talking about like scalability and like some of the best practices you're having to put in place because
yeah,
even if it's under property management, there's still management. Like I've already had to send an
yeah,
email and text my new property manager.
right. No, I agree. And I agree because I've gone through other management companies that didn't work out and stuff.
Yeah.
So to me, it's really managing them. And so I get monthly reports. Most of my property managers use Appfolio, or one of them use Buildium, but they've got all
Hmm.
these softwares out
Yeah,
there.
those are the two big ones.
So yeah, so it's really, to me, it's staying on top of the monthly reports. And if anything fishy comes on, being proactive and reaching out to them, kind of keeping my own list of things to keep tabs on and stay in the loop. Like instead of just waiting and being reactive to what they send me, being more proactive in that approach. So I do rely on them a lot, the property managers, but there's definitely that managing of property managers. And just one thing to keep, like one example of that, very simple example, is with the 4 unit. I need we have a new property management agreement, and they switched from the paper agreement to now a digital version of that, and I'm looking through it and it's not the same. So I'm like, oh
Mm.
great, like we already had these agreements in place for a couple of years, now I got to go through and check this thing. And they had an attachment to it, like an addendum, and it didn't have all the things we negotiated when I first started working with them. And so it's like, don't, that's the biggest thing in my opinion, is just don't get comfortable working with somebody else. If you're going to rely on other people, don't get comfortable with it. Don't get complacent. That's huge. In the Marine Corps, we say, so I'm a veteran. In the Marine Corps, we say complacency kills, because it literally, the Marine Corps will kill you if you're complacent, meaning you just get too comfortable with your situation and you just start letting things slide, the little things slide. It's a slippery slope. So that's just an example of that. But, another example is for the single family BRRRR method that I did, it was my first time using this property management company they hired a subcontractor to do the work, but they oversaw it. So
Yeah.
they did the project management, and I've been kind of screwed over before by a different company doing that kind of role. So this time I had my stepdad, of all people, but his career has been in that field, kind of. He was what do they call it, maintenance supervisor for a big apartment
Okay.
complex. So he actually offered, he's like, hey, I'll drive down there, just pay me for the gas. I'll drive down there and I'll do like a punch list walkthrough. So it was like, I mean, the third party is the manager, but this is like a third party to the manager,
Sure.
who's back checking the manager, who's back checking the contractor. So you got all these different
So
layers in
frustrating,
place.
isn't it?
Yeah, it's so annoying. But hey, man, if I'm not there, I mean, if you're there personally, you can just do that part
Yeah.
yourself. You should be there. You should drive by your properties every month. You should keep eyes on it and keep tabs on it to make sure, because stuff can just get crazy pretty quickly without you knowing when you're out of state. So there's all these things. And then I do travel there. Again, I have family there, so this is why I picked Wisconsin. I know the area and I have family there. So I'm like, hey, when I travel there every year, it's a write off, but then
I
I'm
did
going to
that for
drive by.
Nashville.
Yeah, yeah, right. But then, I do drive by the properties, and it just externally just drive by, because that's a quick precursor. Like if something is wrong externally, then there's probably something going on inside as
Right.
well. If you can't even cover up what's on the outside, something's probably wrong on the inside. And so that's been helpful too. So just those different things. I also have a bookkeeper, and that's kind of another third party way to keep my property manager honest, because they notice things in the reports from the property manager that I send them monthly. And they'll be like, hey, tell me about like what happened here. And then I'll bring the property manager and they'll go back and forth and we'll try to sort it out. So we're actually doing that right now for some of the books. So it's just, you know, I know it's like many cooks in the kitchen sort of thing, but man, if you got to rely on yourself for everything, you're gonna miss things. And so having those third parties involved to kind of cross check each other, checks and balances, is really important.
But it almost sounds like you're heading towards self management at that point. So, like, for example, me and a business partner, we self manage one of our properties. To his credit, he actually takes on the bulk of it because he has more management experience than I do, even though I'm the one who's actually real estate full time. But then we've also hired an assistant, a virtual assistant. She's handling a lot of it. So to your point, it's like if you already have the bookkeeper, you have someone who's willing to drive out there to even double check the work. But to be fair, a handyman can send you photos. Where do you draw the line between having a property manager that's charging, what do the latest reports say, like 15 to 18% of the rents when you factor in finding a tenant, upcharging for this, upcharging for that, versus just managing yourself and then having those, basically your team in place?
Yeah, I don't want to deal, for me, I don't
Sure,
want to deal
everyone's
with
different.
the headache of maintenance, because my 5 and 4 unit, I mean, I already know this is going to happen with the 4 unit because it's the same area. In Milwaukee, there's going to be a lot of maintenance required. These are old buildings. There's just going to be maintenance calls, and I don't want to deal with that. I just don't want to deal with it. Even if it's just coordination, I could see getting to the point. Where I hire an assistant to handle those calls and have the people in place, to have the handyman mainly in place to handle most of it. So I could see it getting to that point at some point. The one thing I'll say with the property manager I use in Milwaukee is that they are now, it's a broker, and then they added the property management services, but now they have their own contractors they're hiring in-house too. So they're getting their labor rates are like, their rates to do these projects are much, much lower than anybody else that if I hired them myself, I'd pay way more on that. So it kind of depends on your business model. And if you're, in my case, like if I wasn't doing any rehab projects, I never needed, I'm buying like newer properties that don't really need much CapEx, then it wouldn't make probably any sense to go with this management company, But if I'm buying in the areas I'm buying in, and I know it's going to need maintenance, and I know there's going to be some CapEx coming up just because of the age of the properties, to me, it's like I'm paying monthly so they can handle the noise that I just don't want to handle right now. And then when I need those projects, they're there for me and can support me. So, but I wear the 10X badge, so I'm a Grant Cardone guy. He's way different business model. He buys A-class properties in A-class neighborhoods, hundreds of units per property. He has a massive team under him, and he, there really isn't the big CapEx that I see, the big maintenance issues that I see, but he just hires the people to deal with it when they need it. So certainly he's not taking those calls. Certainly he's not taking those calls, and it's probably a few steps below him, the people who are taking those calls, several steps, even like finding the deals, negotiating the deals. I think he's very hands off on most of that process, to be honest.
It was interesting. Most property managers I interview in different markets, like, hey, how did you get started? Most of them say, I already had a rental portfolio.
Yeah.
Right.
Yeah.
So like what I tend to see is someone self-manages their first couple of properties, and then at a certain point, you need a property manager just because it becomes too complicated. But then you get so big that you're like, well, no, I'd rather bring it in-house because that's where the savings are. You could hire. I have a client of mine who has a bunch of rentals out of state. He's paying over $40,000 a year in property management services. So he's like, at some point, he's going to be better off hiring someone in that market for like $30,000 a year, or even $40,000 a year, because he can just keep scaling.
Or, if you get to the point where you're owning bigger apartment complexes, some of these management companies they'll dedicate one person who literally has an office at that apartment complex. And you're paying a lower percentage because you have so many units with them.
Yeah.
And they have one person, like you're paying that person's salary with your apartment complex, basically. So it's like you're hiring them, but you're not dealing with the whole hiring, firing. I got to go find the right person. It's the management company. So I've seen people do both ways, even when they're scaling, because there are economies of scale. The property manager I use, they're smaller. much smaller, but even with them, they're like, hey, we'll drop it to 8% when you get to this many units that under management.
That's what I've noticed.
But I brought that up. They didn't have that in their system till I asked them, and I don't know, we never thought about that. So now we brought it up, and then if I scale a little more, I would ask them again, hey man, now we're here, can we drop it some more? Because when I'm looking at what brokers are underwriting on bigger deals, like in the 30s and 40s of units, they're putting like 5% property management.
I noticed that.
Yeah.
I noticed that recently, that they didn't put a really high percentage. I'm like, how? But you're right. Because I've been fortunate, but my property manager's already told me, hey, there's a discount because you're bringing over so many units anyways. Yeah. But to a certain point, it just becomes economies of scale for the property manager. And then they're still going to make way more money off the tenant placement.
Yeah. Yeah. Well, and then that depends on their SOPs, right? Because, and how they're charging you, because the one property manager in Milwaukee that kind of does what you're saying. I mean, they charge half month's rent when they fill the unit, which seems to be fairly standard, but I know some who charge a full month's rent, which I don't think I'd ever pay that. That's kind of crazy, but I don't know. People do it. So if people do it, maybe it's not crazy. I don't know. But then I have another property manager. I mean, to be fair, they're only managing one duplex for me. It's just a different part of the state that these guys don't work in. But they just do 10% flat. They don't charge anything else. Flat. 10% flat. Yeah, right? It's like, hey, man, you get paid when the unit's filled, and you get paid when the rent's collected because that's your job. That is your only job. That is your number one, not your only, that's your number one job. If you're not collecting rent, then I don't need you, man. It's kind of the thing, right? Like that's the whole point. So if you're not collecting rent, either there's something wrong with the unit, which means you weren't paying attention and didn't keep up with it. So I like that business model, but nobody else is doing that. So I don't know how long they'll do that and how sustainable that'll be, but I like it. And nonetheless, I worked with them because they're also brokers, and I worked with them to submit an offer on a 28 unit, and they were going to manage it for 8.5%. So they were going to do the same thing. They were going to scale back, even though they don't charge any other fees, no lease up fees, no like adders. Like some will charge, 5 or 10% on top of any maintenance.
Right.
Just all these just nickel and diming kind of things. They don't do any of that. It's just flat, So.
Yeah, I was talking, the podcast episode hasn't aired yet, but I interviewed someone who has property management at company and software. And she said it best. She's like, these property managers, they make money off of you failing.
Yeah, it does happen that way. Yeah.
It's disappointing. Like the last property management company that I fired, their fees were super reasonable. Then all of a sudden they raised some of their fees. But which some of it, I'm like, I saw it coming because I'm like, you're charging too little. But one of the things they started doing, which I've heard before, is a vacancy fee. And I'm like, that's BS.
Yeah.
I'm like, because the fee difference, because some of these markets, as you know, like the rents aren't that high. So like the 10% or whatever it is versus the vacancy fee, it's so close. It's like, it's in their best interest for it to be vacant.
Yeah. And this same company that manages these properties for me in Milwaukee, they had that. And I pushed back on that initially. But then they changed it to basically say, because they verbally told me this, and I'm like, okay, put it in writing, So they changed it to basically say like, hey, there's a $50 a month vacancy fee if the owner chooses to keep it vacant, because that's what they said. They said that, because they had some owners that just, I don't want to deal with it right now. They just leave it alone. I don't know why, but that was apparently they had clients like that. So like, all right, like, that's fine. As long as you have it in there, like as long as you're not charging me while it's vacant and you're charging me to fill it. And it's just, you're getting charged all over the place, man.
Yeah.
And then there's like common fees, right? There's, you bought a property. Okay, now we're going to charge you this much per unit just to add them into Appfolio, like, okay. All right, man. It's like where, at what point is this just part of your job? Like what is the 10% cover? Just collecting rent?
Processing. That's exactly what it is. It's like if everything else is a markup, that's all it's for. It's like, it's to take the call. But you're taking the call and then you're upcharging me for the maintenance.
Right. Yeah. And the 10%, it's like, dude, everything is electronic, like for the most part. It's all just automated in Appfolio. So I guess it's paying for Appfolio, maybe, it's like I don't
I
know,
will say
man.
one of the advantages to property managers, I know we're knocking on them, but one
Yeah.
of the things I do appreciate,
Man,
like
if my
property
manager
managers,
watches, he's gonna be like,
we're both
he's gonna stop
screwed.
taking care of me, man.
Okay, so like we'll keep this episode, quiet. But one of the things I will say is one of the biggest advantages is if you're investing out of state, if I see a property I'm interested in, I'll send it to them. I'm like, hey, would you manage this? If they say no, then I already know it's that bad of a neighborhood, right?
Yeah,
Like that to me is an easy test because the problem is not like you even mentioned it. You have some rental properties in not the nicest of neighborhoods, but there's one property that's on the nicer part of that section.
yeah,
Everything's street by
yeah,
street. There's a neighborhood in LA where like as a whole, not the greatest part of LA, but it
yeah,
is street by street. Some streets are super nice. One
yeah.
or two streets over, a little rough. So like it just
Hmm.
happens. So yeah, they are your boots on the ground because the realtors,
Yeah,
and I am a realtor, so I'm a little bit biased, but some are commission whores,
yeah,
right? So they're gonna look and say,
for sure.
here are the numbers, like here's what it would rent for. You run the numbers.
Yeah,
Do you like it or not? Let me get my check. Versus the good agents are like, hey, this area is kind of rough. Like I never tell a client not to buy a property. I usually say, here's some things to look out for. Here's
yeah,
some things to consider. Because it's their call. If they're like, yeah, I know the neighborhood's rough, but I'm not going to live there, then they might invest
yeah.
there. Like that's their choice.
And to be honest, on this 4 unit, because my property manager is representing me on this one. It's the first time he's
Yeah.
representing me buying a deal. So there's that risk too. And he's giving me numbers and I'm like, these numbers are way higher than this property. Why? Like it's the
hmm
same zip code. But he's like, yeah, but this one is like I was saying earlier, the unit size is like double the size of the units. You got a 3 unit in there or 3 bedroom in there. And then he's like, remember this property we looked at for you? This is like 2 blocks away from that. That's the kind of area. He's like,
mm
yeah, it's still this zip code, but he always warns me about the zip code. So, but
Yeah.
then on this one, he was, this is actually a pretty good one. It's a pretty good one. So I'm like, all right. So that gave me the warm and fuzzies. But now he's the one who's got to own up to those numbers. Like he's the one who has to get those numbers, right? So if he can't get those numbers, because I literally asked him 4 different conversations, 4 different times I asked him, like, hey man, are you sure about these numbers? Hey man, remember this property that's getting these numbers. Why do you he's like, Chris, he's like, I'm so confident on these numbers. Don't worry about it, dude. We're gonna get the numbers. It's gonna come in. He's like, maybe on the 3 bedroom instead of 1350, maybe get 1300. If you want to be, conservative, put 1300. But he's like, but I'm not worried about it at all. I'm like, all right, because he's
That's
just got
confident. That's
yeah.
super
So
confident.
I'm like, hey, if we get it and we don't get the numbers, like I asked you 4 times, you were that confident. I know there's only so much you can do. You can't guarantee this stuff and whatever, but I'm like, all right, so this is a test. I feel like I'm testing my property manager, and you got to, because they can get complacent too,
Yeah.
and they can see if you're starting to get complacent, and then they might start to pull back a little bit. Or maybe they're having swings in their business where maybe they just got a big client and with hundreds of units, and now they're going to put all their attention on that client and stop
hmm
caring about your little projects. So yeah, you want to, it's just, there's so much, but you really never want to stop testing your property manager on these things and
Yeah.
managing the
Keep them
property
honest.
manager, right? Keep them
I
honest.
agree. So, you know, some of what you do is also kind of like tracking some like market insights, things like that. What are some trends you're seeing now that interest rates have kind of like they are what they are, the market is what it
Yeah.
is.
Yeah.
What are you seeing?
I mean, mostly, in Wisconsin, I am starting to see more deals just generally. And I don't know if that's the sources I look at, which would be wholesalers. And then I'm always engaging with brokers that
Hmm.
I've either worked with before or I've just inquired about deals before. I'm always following up with the brokers to see what kind of deals that they have, maybe pocket listings that are off market and stuff like that. That's how I got the 4 unit. Marketplace is another one, which, there's ups and downs on there. And then the MLS as well. But I haven't focused heavily on the MLS, but I recently actually interviewed someone on my podcast who I thought was pretty good, and he really knew Milwaukee market as well. So I'm like, hey man, let's see if you can source some deals for me off the market. So at first, all he did so far was kind of set up alerts, and I feel like that's all it's going to happen, which is, all right, I could have done that myself. But even with that, I get the emails, and I'm like, man, there's a lot of, I mean, just at first glance, there's just the numbers at first glance look good. You got to dig into it, but those are on market. I'm like, why am I even dealing with wholesalers if I can get the same price on these on market deals? So
Safer.
I don't know. Yeah, they're safer. I mean, you get representation. You get your contingencies. Right? Yeah. I lost earnest money going through a wholesaler because, they let me do the inspection. Like they let me in to do an inspection, but they wanted to have, and it was a very low earnest money. I mean, it was like, I think I gave them like $300 or something like that.
Yeah.
It was fine. But I knew that I was going to lose it if I didn't go through it. Like there was no contingency in the contract. So yeah, you are protected from that standpoint. So I paid that plus the inspection, and then found that they had issues with settlement and stuff like that. There were massive issues that I just didn't want to take on. So anyways, that's what I've been seeing. But yeah, rates have come up recently. Definitely,
Sure.
From when I did the 5-unit a year ago until now, it was a credit union. They were at 6.9% or something with that deal, and now they're at like 7.25%. So it's gone up a little bit. DSCR rate on this one is 7.55 that I was quoted, so a little bit higher. They're always a little higher than the credit unions,
Yeah.
But I mean, if the numbers work on this, even with 7.55% and all the fees associated with the loan and the closing costs and the rehab, like the cash flow after all of that is like $400 a door, and I'm conservative. I'm conservative with my numbers. So my goal is usually $200 a door. So I'm like, let's go. Let's do it. Yeah. So I'm actually, borrowing. I was going to partner, but I'm just going to borrow money, basically do it like a second, instead of doing a fix and flip loan, just using private investors, my friends, 2 of my friends, their IRAs. So, for any listeners, if you don't know this, if you have an IRA, you can do a self-directed IRA, and you can lend money on real estate deals, or you can actually buy real estate deals with your IRA. So there's ways you can get in if you don't have money individually, but you have it in a retirement account. And so, I'm told them, I'm like, I'm willing to pay them 10% interest only. I'm like, the deal covers it and way more. Like it's so, yeah. And they're going to be in it for 5 years. I'm like, who's paying 10% for 5 years? I am.
Right.
On this deal, it supports it. So I'm like,
I've told people that when people are like, oh, well, if interest rates go up, no one's going to buy. I'm like, look, I'll gladly pay 20% interest. If the numbers make sense, the numbers make sense. Like, what do I care?
Yeah.
Now, I've told one of the things, and I've been telling agents this because I have some investor clients. And so like some of these properties where they're like, well, the tenants are paying really low. I said, that's fine for my client. It just has to be reflected in the price. And he did not like that response. And I'm like, well, what do you want me to say? if it's fully rented, I can't pay what the seller wants unless it's up to market rents. But in markets like LA, where there's rent control and you can only raise rent so much, like our hands are tied. And like, oh, you can do cash for keys. Okay, now my price just went down because I have to factor in, $20,000 to $30,000 in cash for keys. Like it's just, I think that there's this misconception, like you can't make money off a deal. It's like, no, I have no problem writing unlimited offers.
Yeah.
And it's just look, here's where the numbers work. I've done that before, especially when I'm in the middle of a 1031 exchange. I'm like, dude, fling them. I got 45 days to identify a property.
Nice.
I don't care if it's $1. Like we got to fling them because you just never know what's going to stick.
Yeah, absolutely. Yeah. Yeah. And so that is exactly right. Because you don't know what other offers they're getting. You certainly don't know when the other realtor is telling you the truth or not, because they'll tell you whatever, right? Oh, we already got an offer for this much and we turned it down. Like I hear that every time I'm talking to a realtor. Oh, well, we already got an offer for this and we turned it down. I'm like, yeah, you're basically telling me you're low end is all you're telling me right now is, hey, this is like the lowest we'd probably go, because we turned down, maybe they did. I mean, I don't know. I'm not.
Or maybe the market is telling them what the property is worth. right? Like,
Right. I'm
if
like,
you're
where'd that
getting
number
multiple,
come from? Yeah.
right? If you're
Yeah.
getting
Yeah.
multiple, like I've done that
Yeah.
with my sellers where
Yeah.
like the home's sitting, we're getting offers. So I'm like, look, we're getting offers in this range. The market is telling us this is what it's worth.
Yeah.
What do you want to do? Like, it just
Yeah.
is what it is. Because you're right. I mean, are there realtors that are bullshitting? Probably. I always try to think the best of like they have an because they do have
I
an
don't know. I'm
ethical
so negative.
obligation.
Ugh.
No, I don't like most realtors, to be fair. I don't. A lot of them,
Yeah.
and it's not even that they're BSers or anything like that. It's just sometimes they don't have the experience. They don't, it's especially since 2021, it's really become a team sport. So when agents are dicks to me, it's like, dude, do you want the property sold or not?
Yeah.
I have a buyer. Let's have a conversation. If it doesn't work, it doesn't work. I remember I wrote an offer for myself on a property and the agent's like, this is too low. This is ridiculous. I said, look, I understand it might come off as low. This is literally just what I can afford. Like,
Yeah.
I'm not trying to be a dick. If you don't accept it, I totally get it. Just get me a counter and I'm happy to review it. That's all I'm asking.
Yeah.
I didn't tell him that I was purposely lowballing. I just said, this is what I can afford. Rates are what they are. The price is, the place needs work. It was a great property.
Yeah. And I never lowball like for the sake of lowballing. Some people do that.
I agree.
Some people do that, and that's shady and that's annoying.
It is.
It's like
you get a reputation for it.
Yeah, for sure. And it's like I'm in line with you. Like I run the numbers and I'm like, okay, this is where it's gonna go. And I do factor in the fact that hey, they're probably gonna counter, come up a little bit. So I do go a little bit lower, than what the perfect numbers look like because also nothing's ever perfect.
Right.
And so I got to factor that in anyways. But then, hey, there's a little wiggle room too. So I'm like, okay, if they do counter, at least it's not like, no, this was like the highest top dollar I could pay, so I do that a little bit, but not much, so it's, I don't know. I don't see the point. I mean, like, hey, here's what I can pay, here's what the numbers support from my assumptions. And if they know something that I don't know, show me the info and maybe that'll help. I don't know.
I agree. I totally agree. And even like I've met investors. I don't work with really fix and flip investors because to be fair, a lot of them are paying the ass. Like they're like, oh yeah, send me any deal. I send them a deal. They don't respond. Or like it could be listed for $1. They want to offer 90 cents. It's like, dude, you're wasting my time.
Yeah.
Right.
Yeah.
As a realtor, we don't get paid until a deal closes. So if I have a plethora of clients to work with, I'm going to work with the ones that are more serious, not the ones that are going to write something that I already know is not going to get accepted every single time.
Yeah, for sure.
Right. And then to your point, it's like, if you're heavy into one market, you're going to develop that reputation. I was representing a seller on a listing, buyer lowball, didn't get it. They knew I had another listing coming up. So I told that other seller that, by the way, this guy thinks he's the world's greatest negotiator. Let's tell him higher than what you want. So he told them higher. Ended up being, he got in trouble with his wife for not getting the other house. He ended up paying our full ask. It was $100,000 more than what my seller wanted.
Oh, wow.
Yeah.
Dang.
Yeah.
Dang.
And it's like, I remember calling my seller and she was like in the middle of a lunch meeting. I was like, hey, by the way, they came in at the full price. She's like, really? I'm like, yeah. Because again, I already knew that he had the reputation of lowballing, so we had to buffer it in.
Yeah.
So
let me ask you this, because this is another tactic that people use. And frankly, I don't use this again. It's like, I don't use this as an intentional tactic, but I know a lot of people that do. And I see this in engineering. I see this from contractors all the time as well. And the tactic is basically, hey, we know there's something wrong with the property, but I'm going to just submit the offer that they want. And then I'm going to do the inspection and then discover the thing that I already know, and then come back and counter and say, hey man, we just discovered this. We didn't know about this. Because like even in engineering, contractors do that. They're like, oh, we'll just do change order until we drop it down to what we want, but they know the price to get the job. And so like for me, I've gone through a number of projects that, I got an accepted offer. I didn't do that though. I didn't know there was this issue. I got an accepted offer. Then I did the inspection. Then I did discover this. And I'm also running into the point now though, where it's like all these old houses I know there's going to be something that comes up. I just don't know what it is. And so I still just submit the offer with what I know. and then let the inspection tell me reveal what it reveals. But I hate coming back asking for lower, because it also means I have more work to do that I don't really want to deal with. And I know they're not going to like it. So I don't know. What is your thoughts on that? And kind of like, is that just a no-no? Like never ask for a reduction after the inspection, or is that a tactic? Or I don't know.
I almost always ask. So so I will tell you, it is case by case. 99% of the time we ask for something because it is free to ask, right?
Yeah.
I think one of the biggest things though is every state's different. So how business is run in California is different than other states. In California, you have to disclose any reports you have as a seller. So if I'm a buyer and I'm giving them all these reports, now the seller effectively has a poison pill, because now they have to give all these reports to the next buyer. Yeah. So you're better off playing ball with the existing buyer rather than taking your chances with somebody else. So
I've heard, sorry to interrupt you. I was just saying, I've heard of that being the case, but then when I tell that to other realtors, they're like, yeah, but nobody really plays by the rules, and they're probably just not going to show the next person. And what are you going to do about it anyways? And how would you even know?
Well, every state's different. Some states aren't required to provide it. Most states don't. Okay. At least the ones I've done business in, that's the difference. So because for example, we had to sell one of our properties in St. Louis. And so our realtor was like, well, here's like a 1-page disclosure versus California's 100 pages. But they're like, just disclose what's material. And I'm like, I don't know what's material. That's subjective. And we had just bought it recently. It just didn't perform the way we wanted. So what we ended up doing was we gave them our old inspection report, and then we gave them the contractor's bid so they knew what work was done. I was like, let them kind of compare to see what work needed to be done. But that way, at least I knew I cleared my conscience as a seller, versus in California, you have to provide any and all reports. There is no statute of limitations. So you can have a report from 100 years ago that you would still have to provide as long as it's in your possession. So in California, it's a little bit easier to negotiate credits after the fact. So if I go through a house that needs a lot of work, typically what I've done for myself and for my clients is we don't focus on like, okay, obviously the kitchen needs to be redone. Obviously the floors need to be redone. We focus on things we can't see. All right. Yeah. We couldn't see up the chimney. We couldn't see the sewer line. Right. We couldn't see those things. With that said, we just recently bought a new home. It needed work. I didn't want to spend the time to renegotiate. So I actually front loaded it. I said, look, from what I saw, here's everything that it needs. Hot water heater, AC, furnace, all that. We're front loading the pre-negotiations. And I got almost $100,000 off.
Nice.
Right. And then we went into escrow. I discovered that the termite work was double what I thought. So then we did go back and say, hey, we're asking for a few more thousand. We ended up negotiating a couple $1,000 off. Yeah. But in that particular case, because I didn't want to dick around, and I could tell based on the condition of the house, the sellers didn't want to dick around. So I just front loaded the negotiations. Yeah. So it's really case by case.
Yeah, that's kind of what I try to do, because my property manager, when he walks the properties, like I said, he's got his own crew. So, I mean, he already knows what to look for. It's not an in-depth inspection, but he'll get a preliminary list, like you're saying, and we'll do our offer based on that and just go from there. But then, they almost still always discover something a little bit extra. And so, it is what it is. But I feel like, man, when I start to sell properties later, I just know this is going to come back, and same thing's going to happen. I'm like, I feel like I'm taking care of my properties and doing what I got to do to upkeep them, but they're old houses. They're going to find the same thing's going to happen. They're going to find stuff.
Yeah. My rule of thumb for my sellers, and I actually got this from one of my clients, as long as the request, let's say it's a credit, right? As long as the credit is equal to or less than 1 month PITI, it's worth giving. Because worst case scenario, they cancel, I'm spending that money anyways. Even if I enter escrow with another buyer literally the next day, I'm still spending that money. So that's the typical rule of thumb that I tell my sellers. And because a lot of them are like, I don't want to give them anything. And then once I explain that, they're like, okay, yeah, that's fair.
Yeah.
I'll give them that.
Yeah.
And usually we come to some agreement, because you're right. People are now understanding the expectation of these properties are old, these properties are old, these properties are old. Mm-hmm. And like, for example, on my last house hack, I remember there was some issues with it. And my wife was like, or actually fiance at the time, she's like, well, should we buy it? There's all these issues. I'm like, yeah, but who's to say the next house doesn't have issues? Right? Okay, this one, the roof's fine, but the next one might not be. We're spending 20 grand here on the sewer line. The next one could be 20 grand on a fireplace. Like, we just don't know.
Yeah.
No house is perfect. So,
True.
all right, Chris, this has been amazing. It's kind of nice to like shoot the shit with a fellow investor. So
Yeah,
I
absolutely,
appreciate
man.
it.
Absolutely.
How can people get a hold of you if they want to listen to your podcast, all that cool stuff?
Yeah. So I'm sure all this stuff will be in the notes too, but I'm on all the social medias. Most of my handles are the Flow Authority. I have my website, theflowauthority.com, and you can always email me at cjansen, JANSEN, at theflowauthority.com, and I'll get back to you right away.
Perfect. All right. Thank you so much, Chris. And for everyone watching or listening, thank you so much. And we'll talk to you guys next week. Want to keep unlocking the secrets to building real wealth in Los Angeles? Stick around for the next episode. Tap the video on screen to keep watching.